And I think if you're ready, Governor, libre à vous, bien sûr, de poser les questions dans la langue officielle de votre choix. With that, I think Renee Filipponi, CBC, was indicating first question.
So unconventional monetary policy, the topic today, very fitting. I think a lot of people would say when we're looking at what's going on in oil, some of these ideas, negative interest rates, we haven't really gone that far, talked about these sorts of things. When we look at the reality of these things actually happening, is this a conversation we should be having right now of this being a real possibility, looking to have to go to these measures?
Well, no. I think that we've got all the ingredients of a recovery in place. We've got clear signs that our recovery is underway. It's being masked right now to some degree by the declines, especially in the energy sector, but also in other resource areas. So underneath the surface, we have all those things happening, and the effects of our policy stimulus are still probably only half there. It would take another year for all those effects to come through. So we need to be a little bit patient here on that front, and so we see no reason to be contemplating these measures. It's just that we've been several years since we put them out. We knew they needed updating based on our research and experience in other countries. And I think you should take some confidence from that to know that we have more tools available should, something happen that makes them needed.
We've heard the word patience from you for a while now when you speak, and so we are being patient, but at the same time, you're talking about lowering the bound for interest rates to a negative area. That is something that I think is going to raise some eyebrows here for people, because that's clearly a change in what we've been hearing from you over the past year.
Yeah, but to be clear, we are not talking about doing that. We're making sure that our toolkit is up to date, and so that people understand what degree of flexibility we do have should there be some significant negative shock for the economy. And by that we mean something significant on the order of significance that happened in 2008. That's a major shock to the economy. So you do have the ability to respond more than people might think, given that we're only a quarter point away from the previous lower bound. So you should take some confidence from that, but also from the message that, as we said last week and as we said in October, pieces are coming together. This year started off with us very concerned about the oil price shock and its impact on the economy. And it has played out almost exactly how we laid out in January. I should also take confidence from that the recovery, such as it was, a mild contraction, which was partly buffered by our actions, then followed by a return to growth, even while oil prices have remained low and are still causing all those adjustments to happen. This is the most complex shock that a forecaster can come up against. And so there's a lot of things moving. At this stage, we're quite encouraged by what we're seeing. So there's no pressing issue around these tools. We just want to make sure it's up to date, keep the research going.
Kim.
Hi, Governor Poloz. This is Kim McCrail from the Wall Street Journal. Thank you for taking these questions. I wanted to ask you about non-energy exports. You said today, and you've said in the past, that non-energy exports are what will lead Canada's recovery and growth in the future. October non-energy exports were quite weak. I'd like to ask you to comment on what happened in October and what that signals for non-energy export growth going forward.
So actually, Kim, what I said was non-resource exports, and so that's an important distinction. Because not just energy that's been weak, but other resource pricing and therefore resource flows. So for instance, potash has been soft, and some other resource areas such as ores and metals, and those things we connect to this moderation in growth in China primarily. But in fact, other economies are a little less strong than what we pictured, say, a year ago or close to a year ago. And so the good news is that the U.S. recovery continues to fulfill our expectations. And that, of course, is by far the most important ingredient for an upturn here in Canada. And we're seeing exactly the sectors that we said 18 months ago would respond when the U.S. recovery took hold in the investment space. they have been responding, and that it would be another layer, which is the exchange rate sensitive categories of exports. So in the monetary policy report in October, you'll see a very cool chart that maps out these things and shows you. And if I updated that today for you, it would still be showing that. So you have to bear in mind that the data never go in a straight line for us. They zigzag all over the place, and it's just the natural noise in the data. So that's a good reason for us not to offer running commentary over every data point. That's other people's job, and the financial markets do a pretty good job of it. So.
Thank you. And if I can just follow up quickly by asking a little bit more specifically about the U.S. role in export growth. I think, if I'm not mistaken, for October, and I know you don't want to get too far into the running commentary, but for October, exports from Canada to the U.S. were down. Given that we're going into the likelihood of a tightening cycle in the U.S., can you just comment on where things are headed in terms of U.S. demand?
Okay, well, if we do see the beginning of a normalization of U.S. interest rates, it will be because the U.S. is confident in the upturn that we're seeing. It will therefore be, it will leave the upturn intact. It's not something that somehow takes some of the wind out of the sail. What it does is it actually is likely to be reinforcing, because it'll add to the confidence. As I was talking in my speech about the underlying animal spirits, and it's not just a Canadian story, but it's a common story in many economies, given what we've been through since 2007. Conversations with corporate leaders show us a great deal of caution. When is it going to be sustained growth, as opposed to what I've seen so far? It's been growth, but how can I be sure that it'll be sustained? So if a company survived that, possibly by downsizing or something like this, they're not going to be that immediately ready to add to their capacity and lean with an upturn. And it's that tilting of animal spirits, which we think is really important to the synchronized growth upturn. So we are seeing the ingredients of that in pockets. And so as it becomes more unanimous, if you like, or more synchronized, then we'll know we've got the self-sustaining move. And so that's when normalization begins. And so it's not a negative in that sense. It's a confirming. It's a confirmation.
Governor Greg Bunnell at BNN. In your speech near the end, you said Canada's outlook is encouraging. With oil at $37 a barrel, there's some economists on the street that feel that you're being, after this speech specifically today, a little too optimistic. Are you being too optimistic given where oil is right now?
Well, I didn't offer up a brand new forecast for the economy, Greg, beyond what we said a week ago. Which at that point I don't think oil was $37. So news comes in every day, and our next full update will be in January. And as I said before, the economic data never go in a straight line. And so, you know, if you want a positive reading, well, today we got housing starts, and they were very strong. So the point is that the data are a mix. The shock that we're dealing with is a very complex one, with both negatives and positives. And we mustn't lose sight of the positives. Lower oil prices are very likely to contribute to a significant improvement in growth prospects globally. And global growth is what matters the most to Canada. The external environment has been weak for several years, and if it strengthens further, that will be good news. It'll be good news primarily for non-energy sectors, of course. So I'm not trying to minimize the pain that those companies and their employees are going through, because that adjustment is not just complex, it is painful. But we mustn't lose sight of the fact that this shock that we're going through does have two sides to it. So that's that.
Just for a quick follow-up, you did say the housing starts, the permits were very strong today. You made an interesting comment about housing during the speech. I just want to take a look at. You said obviously low rates favor the housing market, and it's been a beneficiary since the downturn. But you said housing has probably run most of its course. You calling the top of this market?
No, I don't think of it as in the form you express it. What I mean is that we expect in our forecast, as outlined in October, and which I think is still true, that what we'd expect to see is housing to stabilize, where in fact over the next couple of years, housing doesn't go up any faster than economic growth. So you no longer have a rising share of housing in the economy. And what happens instead is you have a rising share of non-resource exports in the economy, and that becomes your primary headline source of new growth, new firm creation and investment associated with that upturn. So the housing market should stabilize in this kind of range in terms of how large it is in the economy, and it's as you suggest, it is fueled by lower interest rates, but it's also fueled by job creation.
David.
Hi, Dave Parkinson at the Globe and Mail. Just want to, I guess, ask you to elaborate on something you just said a minute ago, just so that I want to make sure I understand it clearly. In terms of how you see, assuming we are maybe seeing another down leg on oil prices, and if that's sustained, I want to understand better how you see that playing out, not just in terms of domestic growth, but in sort of the global picture, and how there are, as you said, there are positives. I just want you to sort of if you could walk us through how those positives might play out if we are going through another down leg.
Right. Well, I'll do it briefly. I probably won't do it justice, Dave, but I'll remind you there's a great diagram of these linkages in the January Monetary Policy Report, where we laid out the complexity of this story. So from a global point of view, energy costs are like a tax on growth. The lower energy costs are, generally the more growth you get from the world, because the world is a net user, obviously, of energy. And so what we've been watching for are signs that economies that are mainly users as opposed to exporters, such as Europe, such as the United States, get an extra upleg in growth because of lower energy costs. Now, in some areas, such as here or in the U.S., you get a little bit of a masking of that effect because you have an energy sector that goes down at the same time. So you get a fairly outsized and quick reduction in investment spending in Canada, which dominated our figures in the first half of this year. In the second half of the year, the positives that we've been identifying, gathering enough momentum that they became more significant than that drag coming from underneath. And so this is the sense in which it's complex, and also that the negatives tend to come first. The positives are more about consumers. Consumers have more purchasing power, and it takes a while for them to accumulate that extra purchasing power, for them to decide it's long-lasting, for them to use that extra spending power in certain ways, and so that takes it's a longer process to happen, whereas the cutbacks by energy companies were almost immediate. So that means that the numbers we look at include all those things. So you never get the clearest picture you'd hope. We try to decompose some of those things in the Monetary Policy Report to show you, energy, non-energy, and GDP, and that helps to understand, but it doesn't give you the perfect picture.
And just to change the topic a little bit, in the statement that came out last week, a lot of people noticed that inflation moved from the top of the statement down much closer to the bottom. Some people read some things into that, others didn't. I just want you to, if you could elaborate on what the thinking was about repositioning the inflation statement within that statement.
Well, inflation remains, excuse me, I think my lozenge work there. I get a bit of a throat today. Excuse me. The inflation target remains our primary mission. It's front and center in everything we talk about. So, but as I've told you before, as a team, when we've done our debating and put everything on the table, when we're done with our decision, then we go to a whiteboard and we construct a press release from scratch on a whiteboard. And so Sometimes the story just flows a slightly different way because of what's the most prominent thing that is part of your update, what you're trying to include in your story, what's new. And it just so happened inflation ended up being more or less in the middle of that narrative. But its pride of place is number one. There's no question about that, Dave. So it doesn't mean anything except that that's just the way it turned out.
Got a couple of minutes left here, so time for a couple more questions.
Alistair Sharp from Reuters. I'm just interested, obviously we've had quite a sharp depreciation in the Canadian currency this week, but it's a trajectory that's been going up. On the one hand, maybe the impact has been underwhelming in terms of boosting exports. You might have expected some more. So wondering if you can comment on that, and then just in terms of that rate of depreciation, how much of a concern is that for you in the bank?
Well, a chart we often show in the monetary policy report shows oil prices along with the Canadian dollar, and you'll see that the relationship there has remained quite strong. It's not just a smooth relationship, but actually on a day when the oil price moves, the Canadian dollar moves the same direction. So there's nothing new there. It is when the oil price falls, it is a decline in Canada's terms of trade, which is a very important fundamental driver of economic performance. It means that we're earning less income every day from that source, through that channel. And that loss of income needs to find its way through the entire economy. Cuts in investment spending by oil companies, cuts in jobs by oil companies, cuts in spending of all types, including on salaries and bonuses. People begin to move to different jobs. All those adjustments happen under a terms of trade shock. The Canadian dollar, those adjustments are irresistible. I mean, they must occur. And so if you were to somehow hold your currency from adjusting in that kind of disturbance, you would force those adjustments to happen in different ways, probably more painful ways. So the exchange rate, this is why countries have flexible exchange rate regimes for when shocks like this happen. The exchange rate then is part of the mechanism by which the economy can adjust more quickly to the new circumstances that it faces. And in this case here, what it does is spreads that income effect around, and of course it gives an impetus to the non-energy sectors who have been having some difficulty competing for several years while oil prices were very strong. And it takes time for those things to work their way through the system. We shouldn't be impatient about them. We can see, and the charts in the monetary policy report prove to you, that the exchange rate sensitive parts of the export categories, and that's not all of them, but it's an important part, have been going up very strongly compared to the average. That's a really important insight. You shouldn't miss just because it's not in the total. So that means those are the sectors that are helping to lead the way to the next growth story.
Hi there, Sunny Freeman from the Toronto Star. In your October outlook, you said that the economy was on pace for 1% growth this year, but since then we've seen a bad handoff from Q3 to Q4 with the September GDP at minus 0.5%, the events of yesterday and today. I'm wondering if you're adjusting your fourth quarter outlook at all and the outlook for the entire year, and if not, what would make you actually think about adjusting it?
Well, it's a complicated question, and that's why we have the best team in the business to do all the work to give us a new forecast, and that'll be in a few weeks' time in January. But as we said a week ago, up until that point, we would say that things were roughly on track to what we had said in October. And what that said was that, yes, there would be a weak handoff, as you mentioned, that the fourth quarter would be slower than the third quarter. In effect, the third quarter was puffed up by some special factors that we knew were going to happen, plus the payment of the UCCB, the Universal Child Care Benefit backdated thing. So it looks to us as if households have spent perhaps a third or less than a half anyway of that money, and so there's still some firepower to come through. But, you know, it's important, that's why we mentioned the press release, to remind people we did say that Q3 would be stronger. We shouldn't think of it as the new trend. The new trend underneath it is a little bit more gradual. And so the fourth quarter will be a little slower than the third quarter. At this stage today, I have no reason to say one way or another what's happening to that 1% number. Those are decimal points, in there. I would just one comment, though, on the September number for GDP, bearing in mind that GDP at factor cost is not GDP in the large. It's a share. It's a part of the economy. It's a good broad indicator, but it's not everything. But that negative number was, for the most part, due to a couple of special factors, one being this shutdown in the oil sands because of a fire. Well, as far as I know, that went back online in first part of October, so you'd expect that part at least to bounce back. So, if it's a special factor, then it doesn't change your mind on the trend, right? So you have to, that's why, like I said, the data don't go in a straight line. You have to have a few data points to convince you that something else has happened that you haven't captured in your original forecast. So, see you in January.
I think we've got time for one more.
Okay.
Alison McNeely, Bloomberg News. In the event that the Bank of Canada does decide to pursue unconventional monetary policy, how does Canada's reliance on commodities and expectations that the price of oil will continue to be weak, how does that play into which of the policy options that you've laid out that you would pursue?
I don't know that it would. I can't really think of that in a hypothetical sense. But the mechanism would be, you would some major shock would have hit the economy. You would do your forecast. Your forecast would show you that there was very little chance that inflation would get back up to target over a reasonable time frame, which we usually think of as about a two-year horizon. And if that were the case, then we would have been thrown out of the zone that we talk about, the zone within which there's a reasonable expectation that we will get back. If we're outside that zone, then a policy response would be called for. And what we're saying today is we now believe we have roughly 100 basis points worth of room to maneuver underneath our current interest rate setting, but we also have the opportunity to do these other unconventional things. So all those things would be on the table in the face of a significant shock like that. And we'd have to decide in the context which would serve our needs the best.
And just to follow up on that, you're saying that it wouldn't necessarily factor in, but I mean, there's a fair argument to be made that the price of oil is what has largely carried us into the situation we are in now. So what kind of other major economic shock then do you see that would necessitate the need for unconventional monetary policy? What else could possibly be under consideration?
Well, as I said in the room, you really, when we say major or substantial, we're really thinking about like what happened to us in 2007, 2008. So that was the whole world being impacted at the same time. And it is a context in which there may be a certain amount of collaboration, cross-country coordination of policies, et cetera. And so in that context, you would have conversations about what would work best, who's got the room to maneuver in this way, that way, or the other way. And so all those things would be on the table. You're right that the oil price shock from starting around the fall of last year and going into the new year, about a 50% drop was enough for us by our math by January to throw us out of the zone within which we were comfortable that we would get back to full capacity and stable inflation over a reasonable time frame. It would take more than another year for us to get back. So that's a substantial shock, and that was our analysis at that time. Now, you're referring, I think, to oil prices today, which is just oil prices today. So that's something that we need to analyze longer term to decide if that is that a long-lasting shock. Does it have the same effects as it had back before? Many companies will say, well, if it's $40, we produce this much, and if it's $30, we produce the same amount. And so, yes, there's an income effect, but what is the effect on the economy? It's complicated. So I can't just hypothetically lay that out for you. All those things go into our analysis, and there are other things moving at the same time. We get an updated forecast. If we're outside the zone, then we have to consider what's our best approach.
And I'm afraid we're out of time. Thanks very much, everyone. Bon
Thank you,
après-midi.
everybody.